Good morning, afternoon, and hello. I'd like to welcome everybody to today's webinar, the Top 10 Nonprofit Risk and Insurance Pitfalls. My name is Max Smith, and I'm the Communications Director for 501c Services. Scott, if we can go to the first slide for me. 501c Services is a 100% employee-owned company that provides... Yeah, go ahead.
Trying to get there.
Tried it. It'll go.
It's constipated, Mac.
I'll just keep talking. You'll catch up with me. So 501c Services, we provide services to more than 1,500 nonprofits nationally. We're the administrator of the 501c Agencies Trust, which offers a comprehensive suite of risk management services and multiple stop-loss protection solutions for 501c3 nonprofits. We also provide U-Insure, which is our first dollar unemployment insurance program for nonprofits, government entities, and tribally owned businesses as well. I know a number of you with us today are already working with us, and I really appreciate you for doing so, and we look forward to working with you in the future. Next slide, Scott. So before I hand it off to Scott, who you can see is running the show this morning, I have a couple of housekeeping items. First of all, Scott's going to take questions throughout and at the end. So if something comes up while he's talking and you would like him to address it, please go ahead and throw it into the questions tab of the GoToWebinar platform, and he will answer them as he goes. And then again, he will have a Q&A session at the very end. Today's materials, the PowerPoint presentation, will be emailed to you after the session is over today. We don't have it for you to download now. We will shoot it to you later today. For your recertification credits, we have the full buffet, the HRCI, SHRM, and CAE. If you need those credits, once the session closes, there is a post-event poll. I need you to complete that poll and tell me which credits you need, and I will shoot those to you later on today as well. The poll, again, will pop up when we close the session, and it will also, the link will be included in the email later today. You can do the poll then. So two ways to do that. Next slide, Scott. And before I introduce Scott, who's running the show for me, I want to tell everybody about our next webinar, which is October 4th. Many of you probably already got an email about this. This is actually 5 hours worth of programming. We're going to be in New York City with Mark's Panis on October 4th, and we're doing a whole day worth of programming. It will be broadcasted live. There's CAE credits, there's HRCI credits, there's SHRM credits, there's a whole bunch of stuff. So check that email. I'll send it out to everybody again later today, and hopefully you'll join us for that online session on October 4th. So now I'll get to Scott. Scott is an insurance broker with Hub International. He works with nonprofit organizations, and he was recognized earlier this year by Insurance Business America as a top 100 insurance executive to watch. He's personally one of our favorites here at 501c Services, so we're really happy to have him be able to find a place for us in his very busy speaking schedule. So, Scott, thank you for being here, and go ahead and take away.
Thanks, Mac. Appreciate the airtime today, and especially appreciate all of you joining us and for your interest in the subject. Hopefully I'll be able to keep your rapt attention throughout the session here. I was thinking during my morning commute today, actually, that I'm approaching my 42nd year in the insurance business, and I was just thinking about how many things have changed over that time. Those of you who have been around for a while, I can actually remember the advent of the fax machine in an office that I worked at, when it was first introduced. And then after that, there was the cellular phone. First, it was a great big bag phone. I remember my boss was so proud that he had this thing that looked like a gym bag that was a cell phone. And then after that were phones that were hardwired into cars with a cradle. And yesterday we have the announcement of the 11th generation, I think it is, of the iPhone. I look at insurance companies that have evaporated over the course of my career. There were companies like Mission Insurance Company and Home Insurance Company and Reliance and Kemper. These were all venerable names that have evaporated from the landscape. The proliferation of captive insurance companies and domiciles. We're not just talking about offshore in Bermuda anymore. And then, of course, there are insurance brokers that have disappeared through consolidation. I'm thinking of my old company, Johnson & Higgins, There's certainly Fred S. James, Frank B. Hall, Sedgwick, Palmer and Kay, Wachovia, Hillbrow Hobbs, Wells Fargo, so many others. And we've seen the advent of online underwriting submissions. So it's not all just a paper environment anymore. So despite all of this change, though, there are some things that have still remained constant, ways of doing business that still hold valid today, same as in 1977 when I started out as a boy claims adjuster with Liberty Mutual. So that's where I'd like to spend our time today. I'm going to cover, and I'm hoping that the technology gremlins will stay away. I'm going to break our time together into 5 chunks. First, we'll spend a few minutes. I'd like to share my own perspective on the nonprofit sector, the charitable sector, and some of the characteristics that I see, the way it interfaces with our business. We'll talk about the 10 common nonprofit risk and insurance pitfalls. These are mistakes that I just see people making time and time again. So hopefully we can avert some of those downstream for you. I'd like to spend most of our time talking about these 10 tips to really manage your insurance and risk programming for impact. We'll close up with a few thoughts on where the market might be headed. If you've got renewals coming up in the fourth quarter of this year, we can even maybe take a peek into next year, but my crystal ball isn't perfect. And as Mac said, we'll leave a little time, hopefully, on the back end for some Q&A. So let's jump into it. I should mention, as I said, I'm almost a relic in this business, I think, at this point. Started with Liberty Mutual in claims right out of college. I jumped to the insurance brokerage business 3 years later. And that's really where I've spent the majority of my career, mostly with the global mega firms in a variety of roles. I was in claim management, I've been in sales and sales management, been in relationship management. I had a hiatus in the nonprofit sector myself when I worked for the denominational insurance arm of the National Episcopal Church. They actually had their own insurance company that underwrote and paid claims. They had their own insurance agency. So I parachuted into Connecticut and launched and managed an office that served about 2,000 institutional clients in 20 dioceses and 11 northeastern states from Maine to Pennsylvania, all different kinds of organizations, churches, dioceses, schools, seminaries, human service organizations, you name it. It was really anything Episcopal. So today, I lead an industry vertical specialty practice for Hub International. Just in quick strokes, we're about $1.9 billion in revenues. It's billion with a B, and 11,000 people, 400 offices throughout North America. You can see here some of the organizations that I've worked with over the course of my career. These are all organizations with which I personally initiated and managed relationships. And they're all over the map. Arts and cultural organizations, human services, education, international, foundations, religious entities. A lot of these have been large global, national, and regional organizations, but I've also helped some startups to build their very first insurance programs with training wheels. So based on that experience, here are some thoughts about your space or your sector. Again, I'm hoping that this will advance all right. I never cease to be amazed at how many organizations are really much more than what they appear once we dig into what they're really all about. You face a broad landscape of hazard risks and operational risks, financial risks, strategic risks. You're, I think, resource challenged is a polite statement. Few nonprofits have the luxury of full-time dedicated professional risk managers. I think the risk and insurance function usually falls to somebody in the C-suite. It could be the CFO, might be the COO or the chief administrative officer, maybe a chief human resource officer or a general counsel. But these are people whose time is monopolized by really big picture issues, things like diversifying revenue sources or maybe retaining government contracts, expanding or maybe cutting programs, and simply making ends meet. Those are the front burner issues that people are spending their time on. It's not insurance and risk management for the most part. We find that there's diffuse accountability for risk and insurance. I've been in situations where sometimes a trio of people, it was a financial officer, a legal officer, and maybe a human resource person who all shared in the responsibility, and when things would happen, they'd each point the finger at the other. But it's diffuse, to say the best. So we find that there is certainly a need for expert external counsel and advocacy, folks like us whom you rely on to keep trouble away from your door. One of the things that I especially like about your sector, the nonprofit sector, is that you are capable of recognizing value when you see it, and you're loyal to those who deliver it. You don't put service providers on a treadmill every couple of years to slug it out over lowest unit costs. If somebody's doing a good job for you, if they're responsive, you tend to keep that relationship for a long time. So I view that as a positive, and believe it or not, we do pick and choose the company that we keep. So let's look at today's environment. It's certainly a dynamic risk landscape, and I like to start these discussions by looking at the news. There's been plenty of it involving nonprofits. We've all read of the unspeakable acts of that creep Larry Nassar. He's the team doctor for USA Olympics, and if you look at the aftermath, I mean, it's crazy. He's off to the big house for the rest of his natural life. But you've got over 150 victims and their families who are trying to put their lives back together. The board of USA Gymnastics stepped down. The president of Michigan State University resigned. And from my perspective, there's probably irreparable damage to the sport. We see NGOs, non-governmental organizations. We're talking here about international aid, relief, and development organizations that are under fire in harsh parts of the world. Here, this is a headline about how Save the Children had some people attacked in Afghanistan, 3 people killed. This is back in the first quarter of the year. Right here at home, of course, we've got the active shooters and terrorists who are out to harm large numbers of people. We see a Me Too movement that's exposing sexual harassment by people in high places. Here we've got a headline about Wayne Pacelle, who is the much admired CEO of the Humane Society of the USA. He fell from grace back in the first quarter of the year. There was a foundation out in the Bay Area that had its CEO unseated through a similar episode. So these things are happening more and more outside the nonprofit sector. I mean, just this week we see Les Moonves, the CEO of CBS News, was ousted from his position, and then just yesterday, my old college dorm mate Jeff Fager, who was in charge of CBS News, longest-standing producer of 60 Minutes, he was out as well. So these are some things going on. Oxfam, this is a headline. Oxfam, Great Britain, got tossed out of Haiti after a sexual abuse scandal. So we're reading about international aid and relief workers doing the unthinkable. And then we see like-minded nonprofits that are getting together. They're trying to collaborate rather than going it alone. This is an example of an organization that fell into some trouble, and then they got swept up into another nonprofit. So these are the things that are in the news. What does it all mean to you? There's certainly risk associated with every one of these headlines and more. When we look at the pitfalls, the mistakes that people just so commonly make, I've come up with a list of 10 of them, and these are not in any particular order. This is not like David Letterman's top 10 list, but I see a myopic focus. People sometimes they focus on the most granular things rather than seeing the big picture. They lack risk management strategy. They just kind of run out and buy insurance and say, all right, now we've managed our risk. But that's not a strategic approach. I've always said that if we do our job right as brokers, insurance should be the court of last resort. It's the icing on the cake after you've looked at other ways to manage risk. We'll talk about that in a second. I see folks that are stuck in a comfort zone of the obvious. They're just thinking about the things that are right under their nose, and they're missing the issues that are off the beaten track a little bit. People are inattentive to detail. I would bet that very few people on this call have sat down and actually read their insurance policies to get a fix on what the fine print has to say. But it's that fine print that's going to hang you or help you at your moment of need. We find people that are bidding insurance, and since I've got the bully pulpit, I'm going to use it in a little while, talking about this subject. Poor time management. People, I think, are sometimes just too modest about all the good stuff that they have done, and these are stories that deserve to be heard by the insurance underwriting community. We see a lack of customer engagement, and I think a lot of people feel that this is the broker or agent's job to go chase down the insurance, and they just take a position on the sidelines and wait till it all materializes on a silver platter at renewal time. A failure to leverage broker resources. And then lastly, I would say there's still pretty widespread ignorance to compensation. How are agents and brokers paid? So let's talk now about what you can do to mitigate these pitfalls. Mac, you are keeping an eye on the questions. I'm going to assume you haven't seen any pop up yet?
Correct. We're clear right now.
Okay, good. So let's look at the first issue. These are recommendations that I'm making now. The first is to consider the big picture. If I were to ask each of you, what is your cost of risk? I bet most of you would come back and say that your insurance premiums are your cost. And there's no question that is a part of it. It's probably the one piece that you can most easily put your finger on it. The premium number is right on the front page of your insurance policy. But it is just the tip of the iceberg. And here I'm going to list for you a number of other things that really represent that big picture, the total cost of risk. Deductibles and self-insured retentions. If you buy property insurance, you have some deductible. It might be $500, $1,000, $5,000 that you pay out of your own wallet before you get into the insurance company's wallet. So that's a direct cost to you. You pay that before you get your insurance. Claims that slip into the cracks and aren't covered for whatever reason. Maybe there are exclusions in your policies. You've got a couple different policies, and it's not clear which one is going to apply, and the insurance companies are all pointing the finger at each other. Those claims could be non-covered, and if you wind up eating that cost, it's a direct cost. If you have claims that exceed the amount of insurance that you bought, those overages are direct costs. We look at adverse claims experience. There's a sort of an adage in our business that sooner or later you're going to pay your own way. Well, claims that you have now, this year, are going to affect your cost next year, and maybe the year after, and maybe even the year after, depending on how bad they are. Workplace inefficiencies, that's an indirect cost, but you certainly have to tabulate it. Declining morale, loss of reputation, funder confidence, these are all indirect things, but they do represent part of the total cost of risk. So you need to look at that big picture. This is not just what's your insurance premium on the front page of the policy. Strategy first and insurance last. It probably sounds counterintuitive coming from an insurance broker, but when we look at ways to reduce somebody's total cost of risk, I'm always suggesting that we consider strategy first and we use insurance last. Insurance, after all, is just one tool. It's a way to pay for bad things that happen, but it can and it should be used in parallel with other strategies. So this is all kind of textbook risk management. But I would say the first step would be to just take a look at your risk landscape. Maybe you want to get an external set of eyes to help you with this process. But it's looking at your business, all different aspects of your business, and saying what risks do you face in the conduct of business? How frequent are those risks likely to be? How severe could they be? What's the worst case impact from bad things happening? Once you've done that, then you say, are there ways to avoid and reduce these risks? So it might be, for example, just due diligence in new ventures. If you're getting into a new area of operations, it's really thinking through that and exposing all the potential risks to make sure that that new venture still makes sense after all is said and done. Property protection. You all occupy premises of some sort. Those of you who own the premises maybe have alarms and sprinklers and things like that. Those are devices that are intended to reduce risk. If you've got a corporate safety program, that's a technique to reduce risk. If you're an international organization, you're sending people around the world, hopefully you've got some travel risk management policies in place to keep your people safe and secure. If you've got an employee handbook, maybe it has a social media policy in it. Those are policies and procedures that help reduce risk. And of course, there could be some other preventive measures. We spend an awful lot of time on this next issue, which is risk transfer. Think of all the contracts that your organization is involved with, whether you're buying services from somebody on the outside or whether maybe you're providing services for somebody else. Maybe you're providing services under contract to a municipality. Every one of those contracts presents an opportunity to either be taking on risk or divesting risk. So we look a lot at which way the risk flows in these contracts. Our clients are now in a pretty good habit of sending us contracts when they're just in the draft stages, saying, could you take a look at this? and let us know what we need to be concerned about. So think about which way does the risk flow. If you're asking the other guy in the contract to assume responsibility for his negligence and perhaps to hold you harmless and to indemnify you, you want to make sure that they also have the right insurance in place as the financial backstop. People can promise, till they're blue in the face that they're going to do good things for you, but if they don't have the right insurance, you're really dependent on their financial health and creditworthiness to be able to perform on that contractual covenant to protect you. And the flip side of the coin is, do you have the right stuff? If you now are being asked to assume risk in a contract, does your insurance program accommodate that risk? The last step is retaining risk. So it's looking at your loss history. If you've spent the last 5 years or 10 years paying insurance premiums and you've never had a claim, maybe you want to think about increasing your deductible, assuming that there's a reasonable premium trade-off for doing that. If you get a little bit better financial edge by absorbing some front-end risk, then that might be something to consider. I've always suggested to people that they avoid trading dollars with insurance companies just to have low deductibles. You paying them money just so that in the event you have a claim, they'll pay it back to you. So I would counsel you to absorb a level of risk that's predictable and affordable. That's the risk management pitch. Take it to heart. The next tip is to look off the beaten track. So we all probably know about these garden variety risks: workers' compensation, which has to do with workplace injuries, auto liability claims. If your organization either has vehicles or maybe you've got people driving their own personal vehicles or rental vehicles on the organization's behalf, then you've got an auto exposure. General liability, we're talking generally about claims of bodily injury and property damage and maybe personal injury that result from your premises or your operations. Property insurance, of course, is insurance for your stuff. Management liability, this is directors and officers liability insurance, or employment practices liability insurance, or perhaps fiduciary liability insurance. I'm not going to get into what each of those are about, but this is insurance against the wrongful acts or omissions or misstatements or misleading statements or neglect or breach of duty that your leadership or your employees or your volunteers are alleged to have committed. And then crime insurance, things like employee dishonesty is crime insurance. So hopefully some of these things are familiar and maybe obvious to most of you. But now we need to start thinking about some things that are off the beaten track. If you're dealing with vulnerable people, and that could be children, it could be elderly people, it could be disabled people, developmentally disabled people, anybody who's vulnerable, you need to be concerned about sexual misconduct risk. All it takes is the filing fee down at the local courthouse for somebody to point the finger at you and say that something bad happened. Now you're in the soup because you're going to start running the meter to defend yourself and clear your name. And these cases can be very expensive. Look at Penn State as an example. Look at some Roman Catholic dioceses as examples. They've gone bankrupt. If you are providing any kind of professional services, and this is a little bit of a gray area, what exactly constitutes professional, but if you're doing counseling, for example, or maybe you've got some element of healthcare services that are in the spectrum of activities that you're performing, then you do have a professional liability exposure that you need to be concerned about. Information risk. We've all heard about cyber risk. I think our industry, frankly, has cheapened the subject by using this little 5-letter word cyber, because what we really should be concerned about is information in all of its forms. We're not just talking about things that are electronic. Chances are you've all got some hard copy files sitting in file drawers someplace, maybe candidates for employment with their addresses and their social security numbers and birth dates and things like that. Maybe you've got donor records that are in hard copy, pledge cards that are sitting around somewhere after having been entered into a computer. So information risk is something to be concerned about. We see more and more breaches occurring. I don't think, frankly, that the exposure for charitable organizations is so much an exposure to civil liability, claims that where people sue you for damages over a breach, but you do have the immediate debris cleanup costs, as I like to call it, after an event, a technology event. Now you've got to hire privacy counsel. You may have to do some forensics work. Maybe you have to do consumer notification, depending on what state you're located in and what the laws say there. You may have to engage a public relations firm to do some crisis management work to protect your good name. So information risk is a concern, and those breach response costs. If you're publishing anything, certainly if you've got any kind of a magazine that you're publishing, that's pretty heavy-duty media liability. I've got a client that's a household name in the international relations field. They publish a scholarly journal every quarter. So they must assuredly have a media liability exposure. But if you just have a website and you've got photographs on that website, or maybe you've got some scholarly research reports that you've put together and that are downloadable, or you've got videos that are downloadable, those are forms of media liability that you need to think about. And lastly, if you're doing anything international, if you're just a domestic organization, but you might have somebody go occasionally to a conference or something abroad, like it or not, you do have an international exposure. If on a larger scale you are an international organization that's got boots on the ground in other countries, or maybe people with a transient trip exposure, then that certainly requires some specialized treatment. Moral of the story here is that you should not assume that your traditional insurance is going to do the job, especially for some of these off the beaten track exposures. We see more and more exclusions creeping into the traditional insurance policies that are forcing you to look at some of these specialty issues. So sexual misconduct, for example, you probably need to get some special coverage strapped into your general liability insurance. Same thing for professional liability. Information risk, traditional insurance at best just covers it in bits and pieces. I would not count on your traditional insurance to do the job. Chances are you have to look at a freestanding specialty cyber policy. Media liability may or may not be addressed somewhere in your management liability policy. Sometimes the definition of a wrongful act in a D&O policy is broad enough to incorporate publisher's liability, which would include things like not just libel, slander, and defamation, but things like things like copyright infringement, trademark infringement, and plagiarism. Those are media liability offenses. If you're not getting into the D&O, then probably you need to look at it somewhere else. And then the international, of course, I've already discussed. So it's look at your business holistically and thinking outside the box. I can't emphasize this one enough. Sweat the details. Now, I don't expect for a moment that you will have memorized your insurance policy, much less perhaps even read it. But the moral of the story here is that no two insurance policies are created alike. I get a lot of opportunities to review people's insurance programs. They come to me and say, we don't know if we got the right stuff, Scott. Can you look at our program? And I'll say, sure, I'm happy to do that. And they'll send me a schedule of insurance and say, can you work from this? And I always have to say no. I'm not trying to create work, but the fact of the matter is that every policy is different. You could have two organizations that both buy a $1 million general liability policy. They may be issued by the same company. Chances are those policies are still going to be different because they can always be tailored by endorsements or riders to the policy. So you need to know what that fine print says, know exactly what you're buying. If it's not intuitive or user-friendly, and I wouldn't expect it to be, then you need to lean on your broker. Your broker should be able to explain the high points of the policies, both the broadening features as well as the exclusions and the limitations, and do it in plain English. And lastly, your broker has a legal duty as a professional to highlight the material changes in your program from one year to another, and you ought to insist on it. Your renewal should not be a mystery game. Some examples of these details that can become traps. I don't have enough time to cover each and every one of these, but I'll hit just a few. The first one, coinsurance. This is some language that exists in any property insurance policy, and what it is a financial penalty that applies for being underinsured, and it's exercised at the insurance company's prerogative. So what we do here is take the ratio of the insurance that you actually are buying versus the amount that you should have, and if you're underinsured, you're going to be penalized in that proportion in the adjustment of any loss. So if you only had 50% of the amount of coverage that the insurance company thinks you should have had, you'll only collect 50% of your claim. Bear in mind that most losses are not total losses. It's not that the building burns all the way to the ground and you have not a stick of it left. It could be small water leak claims or other sorts of property losses. It doesn't make any difference. You'll still only collect 50% of it if you were underinsured by 50%. We look at the second bullet point, terms that are narrower in the excess policy or the umbrella policy than the primary policy. Some of you have heard this term umbrella. It's like a safety net of additional protection that you put on top of your general liability policy and your auto liability policy, and there's a section of the workers' compensation policy that's called employer's liability. So this umbrella policy is a buffer. It's a safety net of additional protection that comes into play once you've exhausted those primary policies. The gotcha that I see from time to time is that people buy an umbrella policy or an excess policy that is actually more restrictive than the insurance it's supposed to follow. And I have an example of a human services organization that's my client here in New York. We've been working with them for about 5 years. They've been working with one of the big global powerhouse brokers and asked us to review their program. The chief financial officer of this organization was sitting fat, dumb, and happy thinking he had $50 million worth of sexual misconduct liability coverage. When we read the policy, he did have it in the primary. He had $1 million worth of abuse and molestation coverage in his general liability insurance. But when we looked at the umbrella and excess policy, there was actually exclusion for it. It specifically took it out, and nowhere else in that policy was it to be found. So he thought he had $50 million, actually $51 million protection when he only had $1 million. So you need to be concerned about that. Sometimes we find exclusions for things like liquor liability or professional liability in the umbrella or the excess layer where it's covered in the primary. You just need to look at both and make sure that it follows form or mirrors exactly the terms of the primary policy. Going down a little bit further, fourth bullet point, securing the insurer's consent to engage D&O counsel. We see folks make a false start sometimes when they get served with suit papers against their directors and officers or against the organization because of some wrongful act. Human nature is, I think, to panic, and people immediately rush and they call their friendly law firm and they say, hey, we got these suit papers, please handle it. We need to respond to the plaintiff by a certain date. Well, you can't do that. You can't just run out and hire a lawyer, and certainly not one of your own choosing, at least not right away. You need to notify your insurance company of the claim, and you need to get its consent to retain counsel. Every D&O policy that I've ever seen says that it's the insurer's prerogative and that they should not unreasonably withhold their consent, but you do need to talk to them first. Now we see the same requirements in cyber policies. You can't just run off and hire privacy counsel. You can't just hire forensics firms. Sometimes you've got to engage firms that are on a panel listing that the insurer has put together. So beware of that little trap. Going the next item down, inadequate crime protection. The traditional types of insurance that we see in the crime realm are things like employee dishonesty. So it's an inside job where somebody is taking money or securities or other property. We see traditional coverages for loss of money and securities inside or outside the premises. We see coverage for forgery and alteration. All these old-fashioned kind of things. We're in a technology age now, and I've seen way too many policies that completely overlook things like computer fraud and funds transfer fraud. The ways that crime is perpetrated are much more sophisticated now. Chances are every one of us on this call have received an email that looks and smells like it's from our boss saying, please wire $15,000 to so-and-so. I'm not talking about the Nigerian prince email scam either. I'm talking about stuff in the here and now that looks for real. A lot of people get trapped on these phishing schemes, fraudulent impersonation. So that is something that needs to be addressed in a crime policy. The next bullet point, definition of insured. This is where the last one I'm going to cover on this page. For most nonprofits, this definition in the policy is pretty broad, but you do need to double check the fine print to make sure that that policy definition of who is insured sweeps in all of the entities in your corporate family and all of the individual actors that need to be protected. So that means directors, officers, employees, volunteers. Maybe you want to protect your consultants. Maybe you want to protect independent contractors. These are all things that need to be fleshed out and specifically negotiated. Here is the bidding insurance issue. This, I think, is the way a lot of folks tend to approach insurance when they want to look at something new. I think folks fall into the trap of treating insurance like buying a car or getting estimates to paint the house. It's like going on Amazon and click on insurance and magically a quote's going to arrive on your desktop. I think, frankly, it's more a case of buyer naivete. I don't think it's anybody intending to do bad things. It's just not understanding how our business works. So the problem with this approach is you're pitting multiple brokers against each other to quote. And that all on face value seems all right, and power competition is a good thing. But in doing that, you risk fragmenting the marketplace, because you're going to probably tell broker A that he can go to companies 1, 2, and 3, and broker B can go to companies 4, 5, and 6. And if you've got a third broker in the mix, he can go to companies 7, 8, and 9. So you're trying to make it all neat and tidy like that. But guess what? Every one of those brokers, in telling your story, is probably putting a different spin on it. So first of all, you're fragmenting what is generally a limited marketplace, but you're fragmenting it among too few players. So and then it risks conveying mixed messages along the way. I think this process tends to be transactional. It emphasizes the going in price, that is the number on the front page of the policy, instead of that total cost of risk that we were talking before, and the agent or broker's qualification to manage that total cost of risk. It sometimes results in what I call right horse, wrong jockey. You might have the right insurance company that somehow by luck wound up in the picture, but you got the wrong agent or broker who's doing the work for you. This process needs to be meticulously managed. You can't have these folks just tripping all over each other in the marketplace. You do have to actually assign the markets, as I was describing. And then on the back end, all of the agents or brokers are going to dump their stuff on your desk, and somebody needs to be able to decode it all and make heads or tails, apples and oranges of what you've got. I don't know that too many buyers are that technically grounded to be able to do a fine-tooth comb dissection and really understand what they're buying. I think what they tend to do is just human nature. They go to the bottom line on the Excel spreadsheet and say, I like this one, it's cheapest. There is a better way, and that is through the process of broker selection. So here, through whatever process you like, whether it's just an informal series of discussions, or whether you have an RFP that goes all the way through to swimsuit competition, at the end of that process, you're going to select a single broker to represent your interest. And you're going to give that broker all of the marketplace to work with. Here, the broker is going to be focused on long-term cost of risk. I think it places a lot more leverage in that controlling broker's hands, because the insurance companies that are talking to the broker all know that broker has the authority to be able to do a deal when they come up with the right number and the right terms. It obviously promotes consistency in the marketplace. That one broker is going to be telling the same story to every underwriter that he encounters. And then the real beauty here is on the back end, the broker is going to bring it back to you on a silver platter and give you a side-by-side dissection of the options that they've created. So it's all neat and tidy, very clean analysis, and I think it makes your decision-making much easier. So enough on bidding insurance. Starting early, I really can't emphasize this. Everybody's busy. We're all work to the bone, and I think pulling together minutia for insurance company underwriters is probably pretty low on the list of priorities. But like any other project, an insurance renewal needs to be carefully managed from the start to the finish. So we typically have a mid-year stewardship and pre-renewal strategy discussion with our clients. We sit down and we want to get their report card on how we're doing. How are we doing together in terms of achieving the objectives we set out to do at the beginning of the year? And then we map out a timeline from there. So what are the specific action steps? What information do we need? Who's responsible for these action steps and the information? And what are the dates that we want to get things done? We work backwards from the inception date, when the coverage is going to renew, and we figure out what has to happen on a conservative, not too leisurely, but comfortable time schedule that recognizes everybody's workload. Guess what? Insurance company underwriters also have workloads, and some of them are heavier at crunch periods during the year. January 1st and July 1st are just awful on our calendar because everybody and his brother is queued up in a line to get their renewals done on those dates. New business underwriters, if you're going to an underwriter for the first time with a prospective submission, they do pick and choose the business that they want. So they're looking for fit to their appetite, of course. They're looking at the quality of the underwriting submission. Are there a lot of gaps in information, or is this a nice, tight, compelling story? They look at the specific risk characteristics, what your exposure profile looks like, what your premium and loss history have been, and they do look at the timing. You don't want to ever give anybody an excuse to weasel out because they just don't think they have enough time to do the job. So you need to consider all these timing elements and consider how your renewal fits in with your organization's internal workload. Maybe there's a date other than the one that you're currently using that would be a better, more strategic option on the calendar year. While you're in the process of your renewal, you really want to showcase your strengths. This is not mail order insurance where you let your broker do all the work. You need to be engaged. You need to help your broker to tell a story. Your goal, I think, as a policyholder is to receive better attention and treatment than all of the other opportunities that are on the underwriter's desk. So as an example, last year I took on a client. This is a great big global NGO that's operating in about 15 countries and growing like a weed, couple $100 million organization. And after doing an assessment, we uncovered 50 different gaps in coverage, material gaps. This is not window dressing kind of stuff. When we went to the incumbent insurer to make the repairs, the underwriter just couldn't understand why we were asking for all these things. And the company actually thought that the organization was an entirely different type of business than what they really were. It was a complete disconnect from more than 20 years of operating on autopilot. So at that point, we asked the insurer to assemble its team. We wanted somebody from the domestic property casualty unit. We wanted somebody from international. We wanted somebody from their executive risk team. And we had them come to our client's office to meet our client's C-suite team for a session of show and tell. By the end of that session, we talked for about 2 hours. The insurance company said that it understood and it really liked the risk and it could do every one of the coverage accommodations that we had asked for. So there's a lot of value in showcasing your strength, really telling your own story. And hand in hand goes with that goes meeting your underwriter. You tell your own story best. If you're anything other than a small commercial account, you really need to make a point to get to know your underwriter. It's distinguishing yourself from everybody else, being more than an abstract name on a piece of paper. It is, believe it or not, still a relationship business. Even with the rise of insurtech and technology in our business, at the end of the day, it comes down to humans liking and trusting each other and wanting to do business. So getting to know your underwriter, I think, will help you through the thick and thin of market cycles. The same client that I mentioned a moment ago that had this disconnect with its insurance company in the hands of another broker has now made a point to get to know each of its key underwriters, and the chief administrative officer, the number 2 executive in this $200 million organization, has been able to bond offline with the North American product leader for each of her specialty insurers. And that personal connection, I just can't explain the value of it, but you need to do it. Treat your broker as a partner. This is not a reflection of low self-esteem on our part, but really a comment on what your relationship should be or can be. A good broker ought to be your sounding board, your risk management consigliere, if you will, your advisor. Frankly, for us, there's nothing more frustrating than to receive a call from a client who tells us after the fact, oh, we just entered into this contract, or we just made this acquisition, we just started this new line of business. What do we need to be concerned about? Well, sorry, by that point, the deal's already baked, and our advice isn't going to have a whole lot of value. The idea would be to use your broker as a sounding board when you're thinking about these things, before you go down the road to a merger or an acquisition or a new contract or a lease or any of those things. Give your broker a seat at the table. Lastly, know the deal. I don't know how many of you on this call are in a commission-based relationship with your insurance agent or broker. Some of you may be in a fee-based arrangement. Whatever the mechanism, it really ought to be all out in the sunshine. So there are two mechanisms by which agents and brokers get paid. One is that they receive a percentage of the premium that is paid by the insurance company for the work that they do. And the other approach is a fee-for-service approach. I tend to favor the fee-for-service approach for a whole lot of reasons. I mean, I think it aligns our interests and the buyer's interests in a way that commission never will. It promotes complete objectivity. No buyer would ever have to question my motives in recommending policy limits or the coverages that they should buy or one insurance company over another. We are entirely insurance carrier neutral and agnostic and objective when we're being paid on a fee basis. What we do is strip the commission out of the premium. So we take it out every place that we can, and instead we work with our client who simply pays us a service fee. There are some instances where the commission can't be stripped out, like workers' comp, for example. It's already baked into the rates. And in that case, what we'll do is accept the commission, but disclose the amount to the client, and then we apply it as an offset against our annual fee. So it all comes out in the wash. But the other thing I'll say about a fee-based arrangement is that it enables us to put some skin in the game in a performance-based variable compensation mechanism. We can't do that with commission because it would run afoul of state insurance laws. It's a practice called rebating, where if we were to receive commission, we can't refund that commission to the buyer. But if we're working on a fee basis, we can talk in terms of a possible upswing in our compensation if we did a really great job and surpassed your objectives. Or the flip side would be maybe we take a little haircut because we didn't accomplish all the things that you wanted and you weren't 100% happy camper. So that's something to think about. But the moral of the story here is you can't assess the value of a service, for example, the work that your insurance agent or broker does, without knowing what that service costs. So you need to insist on complete operational and financial transparency. Your agent or broker ought to be telling you every cent of revenue that they receive and where they get it. Mac, this is a logical break point. I'm curious if you've had any other questions pop up, because I'm going to go into a little bit different segment here.
No, we are still clear on the questions. If everybody has any questions, go ahead and send them in, and I'll interrupt Scott as well.
This is one of the most docile audiences I think I've ever spoken with.
You're very thorough. You're very thorough.
Well, let's hope I'm either thorough or it's plain English or something good. Anyway, let's turn the corner. We'll talk about market conditions. So the first premise to leave with you is that the market is cyclical. Rates are a function of underwriting profitability and investment profitability. So insurance companies underwrite your business and they hope to make money on that side, but they take your money and they then turn over to the investment side and they put it in real estate or bonds or some form of investment. So hopefully at least they want to be able to make out well on both sides of the house, and that's going to affect your rates. Market drivers in the bigger picture can include the natural forces of competition. The more folks that you have competing for a finite audience, then the sharper the product is going to be, the sharper the pricing is going to be. We're all keeping an eye on the news now in North and South Carolina, folks that are going to get slammed by a hurricane. So natural disasters and even man-made events like 9/11 earlier this week, those kind of events can shake the market. And then just broader macroeconomic conditions. In the end of the day, you are going to pay, though, for your own risk characteristics. If you've had a lot of claims and don't do a good job at managing risk, the most favorable insurance marketplace in the world is not necessarily going to help you. The graphic here makes the market cycle look fun, but this roller coaster ride is not all great, I can tell you, after 42 years of seeing it. So now I'm hoping that I can get my slide to turn here to the next page. Here we go. Some other terms. A soft market, you'll hear these terms thrown around. A soft insurance market is one where you've got abundant capacity. In other words, you can buy all the policy limits that you could possibly need. It's intense competition. Everybody's vying for market share, so that gets you very broad, generous policy terms, and generally you're talking about lower rates as well. A hard market is the flip side of that coin. So you might have a problem getting the amount or the types of insurance that you need. There are fewer players competing for it, so each has a little bit more license to steal, more restrictive policy terms, and higher rates. If anybody here was involved in insurance back in the 1980s, that was a crazy hard market. I remember little leagues all over the country could not get the insurance that they'd had the year before. They were being asked to pay several 100% more in premium if they could even get the coverage. So that would be an example of a hard market. I would say the last 15 years or so have been a soft market. You can buy everything you need and at a price you can live with. So remember, though, that rates times exposures equals premium. So your rates could be what your insurable property values are. Well, those are exposures. The rates are the rates that insurance companies come up with for different exposures. So if rates are up and exposures are up, premium will also be up. If, on the other hand, as brokers, we are able to drive down the rate, even if you have an increase in your underwriting exposures, maybe we can keep the premium level. If in a soft market rates are down and maybe your business is shrinking some and your exposures are down, then so too your premium will be down as well. Exposures are things like your insurable property values, or your square footages, or your revenues, or maybe the number of client encounters that you had in a particular year. Could be the number of trips that you're taking to different countries and how many people days in those countries. Those are what we mean by exposures. So rates times exposure equal premium. As we look at the market right now, I would characterize it as still a moderately soft insurance market. I have been reading in the last week or so, though, about some uptick in rates during the second quarter of the year, maybe carrying over into the third quarter. I've seen one firm talking about increases on the order of about 3% or so for year to date. We're seeing more and more insurers and brokers that are consolidating. I don't mean insurers and brokers consolidating together, but insurance companies eating insurance companies and brokers swallowing up brokers. So with that consolidation, it leaves somewhat fewer choices for buyers. We're seeing program managers that are changing their trading partners. Some of you may be familiar with a company called Irwin Siegel Agency. They do a lot of work in the human services and nonprofit space. They have the pen. They're a program manager that has had underwriting authority for Berkshire Hathaway Specialty, while its old dance partner, AIG, has now partnered up with a company called NSM, which is a program manager that used to trade with Arch Group, which is another insurance company. Anyway, all these dance partners are changing, I think, is the point, and that's something happening. We see insurance companies that are expanding into new territories. We see continuing product innovation, especially in the workplace violence area and in cyber. The product just continues to get better and broader and cheaper in some respects as well, as we've got new entrants coming into the marketplace, especially in some of these specialties. We do see that underwriters are doing some nail biting over natural catastrophe exposures. This latest thing with Hurricane Florence down in the Carolinas. I saw some prognostications that I think it was $100 million loss, million with an M, would be enough to shake the market. I don't know. We'll see. People are always crying that the sky is falling, but it remains to be seen. Cyber aggregation, things like the Equifax breach, where a whole bunch of people were affected at one time. That keeps underwriters up at night. And then the onslaught of Me Too claims. So we are seeing somewhat greater attention to underwriting detail. The persnickety underwriters are spending more time dotting their I's and crossing their T's. When they get in new underwriting submissions, they want to make sure that it's all according to Hoyle. So what can you expect this year? I would say property insurance rates could be anywhere from 5% down to 5% up. General liability rates, probably flat, but maybe as much as 5% up in the months ahead. Auto liability, this is the one trouble spot in the insurance business. It's the one area where insurance companies are just really having a hard time making money. Winter storms this past winter caused a bunch of accidents. We see distracted driving that's running rampant. And those factors and others are just making it hard for insurance companies to make money on this auto line. So I would say generally we're seeing them bump up the rates by 5 to 10%. Workers' compensation, again, this is for workplace injuries. This is going to vary by state. Some states are reducing their rates, some aren't. Management liability, so this would be things like directors and officers and crime insurance and fiduciary liability. There we see 0 to 5% increase. I wouldn't be surprised to see that tick up a little more because we are seeing more employment practices, the Me Too type litigation coming, and even some increase in fiduciary liability. Claims over the way that people have managed their retirement plans. Maybe they haven't made adequate disclosures to pensioners. They were negligent in their selection of plan managers, those kind of claims. Specialty lines, these would be things like cyber, and if you buy kidnap and ransom insurance, maybe business travel accident insurance, those could be anywhere from a 5% decrease to 5% increase. Again, bear in mind I'm talking about rates, not premiums. So you need to look at what's happening with the rate times what's happening in your business with your exposures, and the product of rates times exposures is going to equal premium. The caveat I would leave you is that these are, of course, general indicators. Individual results will vary, as they always say in the fine print. If you're in a tough location, if you're in the Gulf states or southeastern U.S., you may have a tougher time getting or paying for your property insurance. If you're building, for example, is a wood frame building and doesn't have alarms or sprinklers, you're going to pay a higher rate than if you were in a non-combustible masonry building with all the bells and whistles. If you've had claims, you should expect to see some relief on premiums, some effect on premiums, but I think that's more likely to be a problem with frequency than severity. And anybody could have a one-time pop. That's why we buy insurance. But if you had a string of claims, just chronic recurrences, that might suggest an underlying problem that needs to be addressed. That's it. I've got some additional readings that I'll commend to you. These are a couple articles that I've written, publications that put some more meat on the bones than what we've covered here. I'm happy to take any questions if there are any. Mac, you see anything?
Not see anything yet.
Wow. All right. I will leave with you as a closing thought my contact information. Chances are that there is a hub office in your neighborhood. So if we can help you, we're glad to. If you don't know where to go for help, or if you just want to bounce an idea off that came up in this session, this is my contact information. Again, Mac is going to be sharing the complete copy of the deck, so you'll have this information in soft copy form probably before the day's out. So happy to hear from anybody here. I appreciate your time. I think we brought it in as an on-time arrival, Mac.
I appreciate it, and thank you for your time. And everybody, like you said, if you need anything from Scott or I, you know where to find us, and I'll get everybody the slides later today.
Sounds great. Thanks, everybody.
Thanks, Scott.
Have a great day. Yep. Bye-bye.
Bye.